Welcome, guys, to another Market Radar podcast. Let's take a look at the year-to-dates. We've still got NASDAQ leading. We do have the Dow red on the year. Hope you've had a great week. It's been a little rough. It's been a rough week in the equity markets and bond markets as well. But it happens, It's all part of the game. We live to trade another day. Let's take a look at the calendar for next week. We've got a pretty slow week. Nothing too major going on. We do have jobless claims. We're always monitoring jobless claims. But other than that, nothing crazy going on. We have some Fed speakers on Friday. But all in all, fairly slow week. So let's take a look at what ES did this week. We did have quite a pullback going on, but we're at lower vamp. It was an expected move. We were extremely overextended after FOMC, and it's fairly regular price action. We're going to talk about the things that didn't really add up. Actually, let's talk about it right now. So, Gamma, if you want to pull up, we've got HYG. Let's take a look at high yield corporate bonds. HYG is not making new lows, which is very irregular. HYG dividend adjusted is usually a leading indicator for sell-offs, which we're not seeing. That's one unusual thing that we're seeing. Next, let's take a look at the Russell. Small caps typically lead sell-offs as well. The risky assets go first. That's a normal thing. We're not seeing the Russell selling off. It's actually looks sold off less than the NASDAQ. So that's not adding up as well. Then we've got crypto, the riskiest asset of it all. Bitcoin, Ethereum, both not making new lows. So there's something not adding up here. This sell-off, ever since risk on, we have seen bids coming in. So every sell-off getting bought. And we did see that today on Friday. So we had a pretty harsh down day on Friday, which was bought back up before the close. And then next, we've got the VIX as well. VIX not really reciprocating the same move either. So there are just some little things that we're noticing here. Also, our system, fairly unchanged. Nothing really happened throughout this sell-off. The underlying is still strong. We still have strong growth. Growth is actually continuing to accelerate with the metrics that the system is monitoring. So there's really not a lot of tangible reasons for this sell-off. Obviously, the market's always right. You can't fight the market, but this whole sell-off could be a whole nothing burger. It could just be price action,
or a bear trap.
Or a bear trap. I mean, this could be a massive bear trap. We'll see. Obviously, there's a lot of reasons to be bearish, but every time you're coming out of a situation like we've had for the last year, there's always going to be tons of reasons to be bearish. Like, imagine coming out of 2008. Aries went long coming out of 2008. Imagine the bearish reasons everyone had to not go long there. And it's typically, when you're going against the grain, that is typically the right trade. Usually, when it feels like everyone's on the other side of the trade, that's the right trade to be in. And we'll see how it plays out. We could be wrong, obviously. I'm not saying we're perfect. Our system is not perfect. It does have drawdowns, but more often than not, it's pretty right. So today we want to talk about what's on everyone's mind. So there's two things, obviously the two things that our system is built on that moves markets. The only things that matter, inflation and growth. And those are more important now more than ever. We've got high inflation. Has it peaked? Has it not peaked? And then we've got growth. Is growth going to continue to accelerate, or are these rate hikes going to affect growth? So, Gamma, do you want to take us into the inflation aspect of this?
Yeah, so let's talk about the paths for inflation, specifically CPI, and let's first lay out what those two paths are. So we have path one, right, which would be sticky to higher inflation, call it higher for longer, whatever you want, upside risk and inflation. And then we have path 2, which is a continuous breakdown in CPI or inflation. So let's go over path 1. So path 1 would require an incremental higher for longer policy mandate from the Federal Reserve. Okay, inflation expectations would seep into the yield curve, specifically in the 2 to 5 year 2 to 5 year maturities, and equities would suffer after the growth effects wear off. Now, we don't really we have said this, that we do see inflation having a possibility of being sticky, but we don't really see it having the same upside risk as a lot of people might think. Some of these theories on Twitter saying inflation can revert higher, inflation is strong. Um, Inflation's actually been weakening quite a bit, and we'll go over that more in a little bit when we go over the PCE and CPI from from the month of February. We'll break that down, but if you look at inflation as a from a composition perspective, that alone, you have oil, crude, so part of energy, right? Crude's down 20% year over year. So there's obviously weights in inflation that will continue to drag it down via base effects as the months progress here and time goes on further. As long as inflation isn't in the same trajectory it was a year ago, it's going to go down. Now, I'm not saying it's going to go down to zero quickly, but there's obviously some weight on inflation. So let's go over path number 2. Path number 1 was sticky to higher. Path number 2 is the continuous breakdown. Now, unfortunately, people are acting like the Fed is still at zero. Okay, so if we pull up the Fed funds rate, people are acting like the Fed is still here when we look at inflation. We're talking about 6.4% headline inflation year over year. People are like, "Oh my God, inflation's so bad." Yeah, okay, it's not, we were at 9. It's obviously better. It's not nowhere near optimal, but you have to understand where the Fed has gone and where the Fed's expected to go in the next 6 months and where they've gone in the past 12. Extraordinary is what this is.
Right.
Okay, so
So those
like
thinking that like they have to go to 6%, they're acting like that's a huge deal, but in reality, that's three or four rate hikes away.
right, and let's just add inflation on here quickly, and I'll give you, so we'll have a quick rundown here. So here's inflation. Terminals at 543. Inflation's at 6.4. Terminals, the gap here is closing, or terminal moving higher. Now, you might be thinking, okay, well, the terminal's moving up. We have a peak in here at 9.0, what is it? 8.6, 9.1, right? People are acting like inflation's running away and the Fed has to chase it. The Fed has done rather a good job here of inching up against the goalpost here and like basically letting inflation come down to play. And most people don't are acting, or they don't realize that the Fed maybe has to go up another 100 basis points from here, and they are above the rate of inflation, which is where they like to be in terms of policy perspective, where they feel like, okay, I'm the king now, right? Like I'm on top of rates, I'm on top of inflation. I mean, and like that's where they can look down at inflation and watch it go lower instead of trying to grab it from above. They can grab it from below. They can push it from above. That type of mentality, and that's obviously what they're looking to do. So let's talk about a little bit more on what the continuous breakdown in inflation means, though. So it's going to obviously require a hold and moderation of policy after inflation falls below that Fed level. After inflation falls below that level, and for a considerable amount of time, the short end of the yield curve should back off its highs as the market goes up from the Fed rate cuts. Excuse me, goes gears up, not goes up. Now, equities would continue to have the growth boost as inflation pressures continue to lift off growth fuel. Now, what that means is as inflation comes down, the growth proxies should get better, because what ends up happening is you have less and less pressure on growth measurements. And the lower inflation goes, the more you can open up the spurs for growth to move up.
Well,
If inflation,
that's up to a certain point, right? Like you
yeah,
still want some inflation accompanying growth,
of course, yeah.
and
But I mean,
but not
but
inflation at this level.
oh, I mean, yeah. I mean, if you're talking inflation at 0.5%, zero, like that's problematic. But if we go there real quick, I mean, shit's hit the fan in about a million different angles than we can even talk about if
Yeah.
this goes down. Yeah. So now, but let's talk about growth now. So there's a lot of people on the internet that will boast these data points, right? And they'll say many things like, here's A, B, C, and D, and this is why a recession is either here or coming. The stocks aren't favorable. Inflation is this, or dividend, S&P 500 earnings,
Well, there's
I'm
also
baffled on the chart.
the whole argument of every time a positive growth data comes out, people view it as negative because that means the Fed didn't do their job because they're supposed to be crushing the market. They're supposed to be crushing the economy. So if there's positive growth data coming out, they're not doing enough and they need to raise more.
Right. And that's pretty much like that's the problem, because like obviously there's a bunch of people out there that will take the simple things and say something like the S&P 500 earnings yields, right? They'll or I should say the earnings yield, and they'll compare that to where it's been historically, and they'll say like something like 3% right now. Is the lowest or the worst it's ever been, worst for stocks, all garbage, right? All reasons why we're going to get a recession. And then they'll compare certain economic indicators, maybe, for example, the Philly Fed Manufacturing Index, which is extremely low. And they'll compile a bunch of reasons on why we need a reset or we're going to have a recession. The problem is there's obviously a lot of poor data point, or I should say, terrible looking economic data points, but there still is no recession, right? So there's a lot of these weak data points, and there's still no recession to be seen. And it doesn't look like we're going to get one, at least not right now, at least for the short term.
Well, and
So,
the economy is still hot and the market's still pricing in growth acceleration.
right. So, my take on this is rather simple, right? So, if we didn't have a recession yet, and the data points are bad, and everyone's pointing at these data points and saying, you know what? We're going to get a recession. And we don't get a recession. And some or majority of these data points bounce. Now what happens? What happens now? And I think the answer is the soft landing.
So you're thinking a or just the idea of a soft landing.
The idea. I think that is the next leg that'll fuel the continuation of the soft landing. Now, this is obviously given our system continues pointing in the direction it's pointing, and we keep getting the same signals pushing us this way. That the soft landing. Okay, so a lot of people don't understand what I mean by this. When I say the soft landing will continue until all faith is lost in the hard landing, what I mean by that is the soft landing will continue to progress and continue to develop until there's no more faith in the idea that we can get a recession. The idea of recession, oh, we skipped it. Recession canceled, right? That when that becomes a realized belief, the recession has been canceled and it's more than majority, it's accepted by the majority. That's most likely when, at that point, shortly after a recession, has a high probability of hitting. Because it's usually, again, we can talk about consensus positioning being like, oh yeah, they'll put down their guard right before they're about to get punched in the face, and that's what happens. But long story short, I can see an improvement across these data points will help bolster the overall feeling and just the sentiment in the market, allowing the market to basically continue its trajectory higher until something breaks. And obviously, we know the Fed putting rates this high is going to be problematic if it's for a long period of time. If they hold this up here from, I'd say, more than a year, we're going to have an issue. Now we're expected to go out into July, obviously, of 2023 in the fives. Um, Problem is what happens in July? What happens? Nah, call it after the end of the year, 6+ months from now, or not, excuse me, 8+ months from now. We
Mm-hmm.
don't know that yet,
Yeah.
but it's not see. You can't trade what happens 8 months from now today, right? Because what happens 8 months from now is going to happen 8 months from now. But it's what happens in between now and the 8 months from now that is where the trades are to be had, right? So, like, the market can obviously rally or stay bullish until then, because there's if there was a recession, we should have, if a recession was going to happen, we should have seen it already. Something is not adding up. And obviously, the system's picking up on the discrepancy. The market's picking up on the discrepancy. Um, the Fed hiking is, you can make the arguments all you want. Let's go over ZB. So obviously, this blue line, we made a whole bunch of videos and podcasts talking about how bonds couldn't break up above the prior call it double top or triple top, however you want to classify this, after the last two CPI releases going into the January release, but we couldn't break up above here. Bonds started falling apart. And this was along lines with terminals bouncing. It almost happened simultaneously here, right? Where the terminal, and this is the terminal for July 2023. So this is way out. This is grinding up and bonds are going down. Yet the bonds are not at their lows. Terminals are at their highs. What this is telling you, obviously, you have to understand terminals are these are long bonds, 20+ years, right? So the terminal, even though it's up, you have to understand this is shorter lived than 20 years. If we were to look at short-term bonds like 2 years, they're at their low. They're pretty much at their lows, which would make sense
Well,
because
so
within,
so what's the difference between now and when the 30 years were at their lows?
well, I think there was a lot more uncertainty, right? So, like, let's go back in time here. We're talking about the terminal just on a rip roar higher. We didn't have. I think there was also. We're talking about October, right? So let's go. Let's even look at ES back in October.
So there was just so much uncertainty that bonds didn't know when the peak was going to occur, when
Yeah,
inflation
but
was ever going to stop.
I also think that there was much higher recession risk. So people,
Oh, that and
I
that's because growth wasn't where it is today.
right, and I think that people thought that we were going to get a recession and the Fed was going to have to hold rates up and fight inflation. And I think that there was just a lot of confusion in the market. Now, it might not sound so obvious, but I think that they thought the terminals were going to have to go up to 6%, 7%. Now, the
Well, I mean,
idea
we're
was,
kind of in that position now. Terminals could definitely go to 6%, but it
yeah,
seems it seems almost as if there's more confidence behind it.
yeah, but I think it's also the scope of where the terminals have to go. Like, just remember on the inflation rate, we're at 6.4, coming off of 9. Like, we're coming back down. It seems like we're going to continue to come down over time. I don't think that the idea. I think that there's more of a higher probability that inflation has peaked now than any time before in the last any time in the last 12 to 14 months. The odds of the 9% uh, print that we saw in CPI being the peak is extremely high, in my opinion. And I think that because of this, this is much clearer now than it was over here. That I think that there was this idea that maybe the terminals weren't up there, but this idea that inflation going back up was such a risk on the table that they might have had to lift terminals much higher from here, and the bonds just started selling off on that. I mean, this was a CPI print that, again, bonds sold off after, and they bounced up into it. And then we got this print, and they kind of stabilized in between. So if you look between these two prints, there's not really much of a change. So it's not like it's the bonds kind of chopped around here, maybe some fear shooting around, some higher volatility, a more volatile environment. And since then, we've kind of stabilized. And I think that This is telling us that the bond market has a better understanding of where inflation is going. Now, even if the Fed has to hike add 50 basis, the Fed adds 50 basis points to this. This isn't obviously the terminal. This is the rate in July. The terminal is 540, 3 basis points. So this is a little higher than the current terminal, but we'll see where this goes to and how this changes. But even if they have to go to 550, 575, that extra 50 basis points shouldn't destroy the whole bond trade because, or I should say the long-term bond values, because bonds in the end, right? This is 30 years. So if the Fed has to go up another 50 basis points to fix inflation in the next year or two and start bringing it down, then like, okay, do what you got to do. But I don't see the reason why bonds will, especially long-term bonds, and we'll convert this.
Well, they would need to hold rates high for a very long time for it to seep into a 30-year.
Right. Like, let's look at this. 30 years at 393 basis points, right? July rate rate expectations for about 530 basis points. This is rough calculations too, by the way. This is not how you calculate the actual rate. This is just for quick math for the viewers. And even with the rates going up, like here to 533, a long end of the bond curve is up from 359. It's up 40 basis points. Okay. Now it might seem like, oh yeah, you can calculate it's about the same. Yeah, but this is also it's blowing past its prior high. This is nowhere near it because again, this was a time where long-term inflation expectations were getting unanchored and people were getting real scared, selling bonds, thinking that call it hyperinflation. People got scared. Recession, basically an extreme inflationary recession, hit people's nerves, and this blew out. Now we're here. Could we go back up here? Yeah, but you would have to see inflation really take the hold.
Right.
Take the hold again.
And that's actually a very similar situation. Obviously, not to the same extent, but as in the 70s with the two peaks, the two inflation peaks. But the second peak, it's almost like people were desensitized to it. It was like the market expected it. First peak, equities sold off. I don't know if you want to pull up a chart comparing the inflation rate to equities back in the 70s. But you can see during the second peak, equities had no problem running. Obviously, we're not in that same situation. The inflation rate is nowhere near as high, and also the timeline is nowhere near. That 70s situation spanned years, but you can see that even in a rate hike environment, high inflation rate hike environment, equities are able to move up.
Yeah. So let's take a look here, right? So here, inflation took out, we're talking this doesn't look like a lot, but this was 13%. Okay. So equities shit the bed.
Right. Just like how equities shit the bed now. We're in the same situation.
This rolled over. Okay. This fell down. Equities chugged higher. Then we got the second pump. This was the real pump where it's like 19% inflation, but equities much higher than the low here.
Right. Yeah, they were able to hold up.
Yeah, the idea comes around the fact that the Fed had it under control. If we overlay the Fed funds rate, you'll see right away that. Hold on, let's see. Where is this? Oh, I'm sorry. That's 1943. Oh, it's actually funny scenario. Same type of thing.
Right? Oh, I didn't even realize.
I wasn't even looking at the scale. Huh, stupid me. But it must be the COVID that's got my brain all fucked up. But yeah, same type of thing. Look, let's go to 1970.
Yeah, it's honestly a very similar situation.
So here, the first scare, right?
Yeah, first scare, market sells off, just like what we had now.
Second scare, market's chugging higher. We're not saying, and I'm not saying we're going to get a second scare, but this was the inflation shock that got the markets scared. Let's go to where we are today. the inflation shock got the market scared.
Yeah, so we've passed phase one. We've passed the
Yeah.
inflation shock phase.
Now, what comes next? Obviously, a recession at some point, that's where markets like to get really smoked in deflation, but we're not there yet. And let's go over inflation data real quick. So we have over here on the left, we have the PCE, which we saw come out today or on Friday at 5.51% year over year change. We have the last CPI reading at 6.4% year over year change. So, long story short, PCE is bouncing a little bit, CPI is down. What does this mean? Well, if we look at where PCE has been, it's obviously well above average. So is CPI, but CPI is slowly creeping back down to the 2008 pre GFC peak, which PCE has some ways to go. Now, PCE is considered the most, call it, reliable inflation figure because it encompasses some more robust data. So the Fed likes to look at the PCE data over the CPI data. And in terms of what we're seeing, the market was obviously spooked on Friday because of this little blip. Now, I know it's not, we all know it's not the blip. It's more of the longer term projections that the market got scared or market got spooked on. And it's more importantly that the prior figures got revised higher. So we had a above consensus print plus higher prior numbers that were revised higher. So it's like a double whammy. And I think that's what's pretty much spooked the markets on Friday. Let's go back to where the numbers are going though. This number's the CPI number's way off its peak. PCE way off its not as hard off its peak as CPI, but still coming on its way down. As we continue here, base effects, at least on CPI, which these move generally the same if you plot them over. So what I speak about with CPI should work closely in tandem with PCE to a relative degree. So let's talk about CPI. So CPI is going to have the base effects. Alone energy, we're talking crude, is down 20% year over year. So there's going to be some negative weights on this that
do you
will
want to
drag this
explain
lower.
what you mean by base effects for those that don't know?
Right. Okay. So let's go to crude and let's take a look here. And let's look at a monthly chart. Turn all this noise off. Okay. So let's see. Now, obviously, we need to clarify. I need to clarify. Crude is not just inflation. Okay, it's not just crude. Like, this is not the whole inflation figure. This is just an idea. Energy is part of CPI.
It's a pretty big component, so whatever crude does affects it quite a bit.
Right, and the peak in CPI happened roughly around. Well, here, just show you guys. New pane. CPI peaked literally here. So obviously there's something going on here. CPI bottomed literally the month after crude went negative. So there's some weight to be had here. Now, let's talk about basically the simplified version of base effects. So let's take a look at how this is measured. So we have February 2023, right? If we're going to measure the change from last year, if we go from here to last year, and we go to February 2022, excuse me, we got to do it backwards. Got to go from here to here. It's down 19%. Now, there's obviously some other calculations when that go into the inflation basket. It's not so much just 1 year. There's a multi-year measurement. Obviously, it's a little bit different. There's some weightings in the inflation basket. It's not just this simple. But again, this is simplified version this is normalized. Okay, call it normalized. This is real dumb, and it works. Okay, to grasp the concept, it makes sense. So you see how it's negative 19% here. Okay, well, the problem is energy prices go all the way up here. So what happens if crude stays the same and we are on to call it May of 2023, right? So 3 months from now, crude will be down 32%. That percentage just keeps getting bigger and bigger and bigger until we get past that inflationary peak in June.
Right. And we're seeing the same thing with commodities, all commodities. Like
Oh yeah, we can
if you look at
DBC.
DBC, right, same thing. So you have these base effects working towards that working against the narrative of inflation going back up and peaking again. These are all working against it. You really have those base effects in your favor now. Now that we have really seen a peak and it's really starting to materialize. It's been a few months now since we had the highs. It's the We're not saying inflation has peaked because obviously anything can happen, but the odds of inflation going back up to the peak are very unlikely now.
Right. And as you can see here, this is a year-over-year change. This is negative 84 basis points. So commodities are pretty much now into negative territory, meaning this positive move that helped buoy this whole inflationary move or CPI rip higher is now working in an opposite, or it's now an enemy. It's
Right.
not a helper.
And that's good for equities because right now the main weight dragging equities down is the fear of continued inflation.
Right. And
So
obviously we saw that today, right? With the PCE numbers, people thinking
exactly.
that this little, that
Yeah,
this
that
whole
little
move here.
blip means that there's worse to come, but that's the main thing dragging equities down right now. Growth is chugging along. Growth is picking up where the inflation fears are bringing it down. That's why we're not seeing any crazy panic selling. Even in the last week, this was very orderly selling along equities, and we're seeing the Russell holding up. We're seeing risk assets holding up.
Well, that's why we
So
also didn't see the VIX really even today, or I should say Friday,
exactly,
right?
because we have the growth component working in the
Yeah.
background that a lot of people are missing. Everyone's looking at inflation. And so as soon as this fear of inflation, this higher inflation fear that's spreading everywhere diminishes, but growth remains elevated, equities have nowhere to go but up. There's no reason for equities to not go up at that point.
Right. Yeah. That pretty much sums that up rather well. Um, let's let's go on to the last stage of this conversation, which is going to be about the euro, or the ECB and the Federal Reserve. So I went over this last week, talking about the controversial big flip theory, what it means. I we can talk about the big flip. We already did, but obviously this little blip here has a lot of people cheering for the idea that inflation is going to rip roar again. We're not saying that inflation can't remain sticky, but we think the peak in inflation is pretty much in. Um, and what this chart is showing you here is the differential between the ECB and the Fed against their respective inflation rates. Obviously, it's showing that with a negative number and the ECB in front, it's showing that ECB is behind the Fed by a decent amount. Now, what this chart also shows you is the differential is resetting, the euro will follow. If the differential is worsening, the euro will fall. So, as the differential here or reset or got better for the ECB, the euro was able to bounce up off the lows from 108 all the way up to 121, 122. That's 22% on a currency. That's rather good. Now, the differential is slowly lifting off the lows here. Um, if you don't know the situation in Europe, this is what it looks like. The ECB is at 3%, their inflation's at 8.6%. In America, the Federal Reserve is at 4.5. Oh, it's 4.53. Let's see, 4.58, and the inflation rate is at 6.4. So the Fed has done a much better job compared to the ECB, and currently between Goldman and Deutsche and these other banks, they have the terminal target for the ECB at 3.5 to 3.75%, which that is a joke. That's a joke,
Yeah, so
right? Like,
there's like upwards pressure on the
right.
euro essentially if they have more room to hike than the Fed, right?
Well, yeah, it's more of like, okay, so this was our conversation last week in regards to the dollar. So let's bring the dollar up quickly. The reason why the dollar was this behemoth was exactly what you're seeing here. The euro was no the euro didn't had no room or had no hikes to fill its sails until later in the game. The Fed was already pumping hard by that point. And the dollar just moved up. We were the pretty much the smartest or you know how they say the nicest shittiest house in the block, that's what we were.
Yeah.
And that's literally why the dollar had this huge demand. It was seen as the central bank that was doing its best to fight inflation outside of a central bank like the SMB or whatnot that has much better inflation numbers and just control over their economy. The Fed was not ahead of the curve, but it was almost on the ball to a degree. You have to give the Fed some credit. Like, we have to appreciate, especially when looking at the ECB, which is only at 300 basis points, and their terminals like not even 100 basis points higher from here. Our terminals all the way up here for context. So like, if this is true, I don't think that this is true. I think that we're going to see a higher push from here, while the Fed is at five. Remember, the Fed's at 500 and the Fed's here on a terminal, right? 540, 543, something like that.
All right. So even if they do end up going up to 6%, which the terminals are not pricing, that's still very marginal versus what the ECB has to do.
Right. Now, I'm not saying the ECB has to get up to 8%, but I think they're going to try and play the game that the Fed's playing. They're going to hike rates, try and be aggressive to show the market that they care, and let inflation come in and kind of get above it, kind of like what the Fed did, right? Like, the Fed didn't have to hike rates to 8%. We're only at 4.58 right now, and we're expected to get to 5.4 in the next 6 months. So and by then, the idea is inflation's under there. The Fed has inflation under control, and they don't have to hike further. That's the idea. The ECB, I don't see how this comes all the way down here that quickly without them having to hike. I think they're going to continue to hike. It's my opinion. Obviously, anything can happen, but if they do, now you start to see that they have more work to do here than the Fed does or the Fed has. So what that's going to do is it's going to add upwards pressure to the euro. What that's going to mean is the euro is going to get basically be bolstered. We haven't seen that yet, but we haven't really seen the euro fall apart either, and still early stages in this call. My idea is the euro gets the push, the dollar weakens obviously 50 something percent of the dollar, 57% I believe of the dollar with the DXY is the euro. So the euro should get that boost as the ECB becomes more hawkish. Now, obviously, this comes with its own set of problems. The ECB can't be overly hawkish because of the clusterfuck that they're running there with their economic policy across all these different countries. Now,
Right.
how that works, at the end of the day, you'd rather deal with a dumpster fire than a wildfire, okay? Because you can put out the dumpster fire, you can't put out the wildfire. And like, what I mean by that is, if the ECB has to push the fold a little bit to make sure that this doesn't get out of hand, they're going to do that. Because if this gets out of hand, you're talking about the whole Eurozone being pretty much thrown around like a washing machine.
Right. Well, they
And
also have help from the U.S. inflation rate. As the U.S. inflation rate comes under control, it's going to help their inflation rate as well.
yeah, yeah,
So
that's true. Because
they're
it's all,
really they're relying on the Fed quite a bit here.
yeah, because the inflation rate, even though it's US based, um, kind of global to a degree, right? Because part of our inflation rate includes commodities, which are globally priced. Obviously, there's the currency pricing of each commodity in each country. Um, but the euro has been, I don't want to say stable, but in the last, call it 12 months, it's actually not, it's not that, it's not down as much as it was. So it's definitely bounced back. I think this bounce back, as you can see here, is on the idea that the ECB is going to have to be more hawkish, and this should continue. It should, which in turn should boost the euro's performance. Should and then in turn weaken the dollar's performance. We'll see though. That's not we don't really have a position on in that trade. That's more of, I guess, economic theory that's surrounded by the system. Um, if the system switches risk parameters, then it's likely this trade doesn't come to fruition because it would mean the dollar would catch a rebid, be able to ramp higher, and that'll just crush the euro. And that would likely happen if the euro market really starts, or I should say, the euro starts pricing in the idea that the ECB is not going to be anywhere near as hawkish as they should be. But that's for us to see. That's not really pertinent in terms of the current market condition. The current market conditions. The current market conditions are the inflation and growth, which, and to sum it all up, as inflation weakens, it should open up the door and basically take the restraints off of growth. Now, growth will phase out. It's going to happen. Just like everything's cyclical. Just like how we saw the inflation rate here, it peaked, right? Phasing out, cyclical. So is growth. Growth will bounce and will peak and will roll again, and it's how economic cycles work, and we'll get a recession. The thing is when that growth peaks and when it rolls over, and when it rolls over hard enough to be considered a recession is going to be key. And I think that rollover is going to happen after everyone's bought into this idea of the impossible soft landing. And I can't really give you a time frame on that, but I would almost guess that the Fed's going to have to get to basically finish their hiking cycle for that to come to fruition. So at least we got another 6 months, 8 to 8 months on the table here is what I'm thinking. But I think that's where we can wrap up this podcast, and we'll talk to you guys next week.